Hello folks, this is Gus FX Trade. I welcome you all to my channel. In this video, I'll be teaching you guys about market structure. Market structure is one of the most important aspects of price action trading. Market structure is one of the biggest problems traders face, and that's because they don't understand market structure or know how to read market structure. So in this video, I'll be teaching you all everything you need to know about market structure, how to read or map out market structure like a pro trader. So make sure you watch this video till end. And actually, this is the first video of my 2024 mentorship. So if this is your first time visiting my channel, please don't fail to like any of my videos you found valuable, and also click the bell icon to subscribe to my channel so that you will be notified anytime I upload a new video. Thank you. So let's dive into the topic of this video. So what is market structure? Market structure is just the way the market moves. Market structure can also be called the behavior of the markets. One of the most important skills you need as a trader is the ability to read market structure. It is a critical skill that will allow you to use the right price action strategies in the right market condition. If you can master this skill, then you'll be able to answer these questions when you open your chart, which is 1. Who is the control of the market, buyers or sellers? 2. When is the right time and place to enter or to exit the market? 3. When you need to stay away from the market. Once you master market structure, you will be able to answer these 3 questions. So we have 3 types of markets. 1 is the trending market, the second ranging market, and the third, which is choppy market. In trending markets, price generally moves in one direction, making series of higher highs, higher lows in an uptrend market, and making series of lower high, lower lows in a downtrending market. For example, just like you see in this drawing here, price made a high, higher low, a higher high, and another higher low, making another higher high. This is a trending market, and when price is making a series of higher high, higher lows, higher high, higher lows, it shows that market is in an uptrend, which is a bullish trend. So all you will be looking for is the best place to enter, buy to continue the uptrend. And in a trending market, in a downtrending market, when market is making series of lower high, lower lows, lower high, and lower lows, that's downtrend, which is bearish trend. All you'll be looking for is the best area to enter your sell trade and continue the downtrending market. So when is the best place to enter your trade in a trending market? The best place to enter your trade in a trending market. In a trending market, first, in a trending market, the markets are characterized by 2 moves. The first one being the impulse move, and the second one being the correction move. Just like if you can see here, price made an impulse move, creating a high, a correction move, creating a higher low, and another impulse move, making a higher high, another correction move, making a higher low, and another impulse move, making a higher high. Same thing here in a downtrend or bearish trend. So the best place to enter a trade during trending market is at the end of the correction move or the retracement move. Correction move and retracement move are the same thing. You can call it anyone you wish to. So the best place to enter your trade during a trending market excuse me, is at the end of a correction move, which will be the beginning of an impulse move. Just like you can see, once after price made an impulse move and started making a correction move and reached an area of demand, which is the end of the correction move. Price started towards going up and made another impulse move. That I won't be talking about supply and demand in this video. That will be another topic for another video. And as you can see in this downtrending market or bearish trend, after price made the impulse move down, it's retraced to an area of supply before making another impulse move down. So the best place to enter your trade during a trending market is at the area of supply or demand zone. I'll be teaching about supply and demand in another video. So to predict the end of a correction move and the beginning of an impulse move, you have to master supply and demand. Excuse. But don't worry about yourself about that. I'll be teaching you guys about supply and demand, but not on this video. So let's move over to ranging markets. So what is ranging market? A ranging market moves in a horizontal form where buyers and sellers just keep knocking price back and forth between the area of resistance and the level of support. Just like you see in this example here, price moves up, reached an area of resistance, bounce back down, reach an area of support, moves back up again to resistance, moves down. This is how a ranging market looks like. This will generally continue until the range structure breakouts and a trending condition starts to organize. That's, for example, price will continue trending between this range of resistance and support level until one of the players takes control of the market, which is either buyers take control of the market or sellers take control of the market. That's when price will break out of this range. For example, price can break out of this range from the support level and making a retracement. You start creating lower lows and lower high. That's a trending market have begun, which is when price does something like this, it means price has started trading down, which is a bearish trending market have started. But also price can also break out from the resistance level, makes a retracement, makes a higher high, higher low, and a higher high. So that is it. So how to trade a ranging market? Where is the best place to enter a ranging market? The best place to enter a trade in a ranging market is to sell when price is at the level of resistance and to buy when price is at the area of support level. And another best way, that's the high probability way to trade ranging market is to wait for the breakout out of the range. When you are trading a ranging market, always make sure that the market is worth trading. If you feel like you can't identify the boundaries, that's the resistance and the support level, then this is a clear indication of a choppy market, because in a choppy market there is so much noise that it will be hard for you to identify the direction of the market, just like you can see here. So let's move over to choppy markets. What is choppy market? Choppy markets are those with no clear direction. You can't even decide if the market is ranging or trading or trending. Just like you see here, there is so much noise here. You can hardly identify if the market is in a range or is in a trending market. So if a market is choppy, the best thing to do is just stay away from the market, sit on your hands, don't do anything, wait for a breakout before you start trading. But if you insist and try to trade, there is a possibility of you giving back the profits you have already made from the market. So the best thing to do during a choppy market is to stay away from the market. Alright guys, this whole drawing is here is just a textbook example. So let's move over to live chart and see how the market looks in trending markets, ranging markets, and choppy markets. Here is a live example of how price looks in a trending market. Here is a live chart of an uptrending market. As you can see, a price made an impulse move creating a high, a correction move creating a higher low, another impulse creating a higher high. Most people, those that use wicks as break of structure, can call this a break of structure, but for me this is just a liquidity grab or a fake out. This is not a break of structure for me. My break of structure is confirmed when price breaks structure with a body candle, not with a wick, though I'll explain that in the second video of market structure. So back to what I was saying, as you can see, price created a high, made a correction move creating a higher low, made another impulse move creating a higher high, another correction creating a higher low, impulse, higher high, correction. So continues until it gets here and breaks this higher low, creating a low, creating a lower high here, making a lower low here, creating a lower high here, making lower low, making another lower high, and making another lower low. So this is how the market looks in a live chart. Yeah, a trending market, how it looks in a live chart. So let's see how the market looks in a ranging market in a live chart. You can see here, this is how the live chart of a ranging market looks. Price moves up to area of resistance, bounce back down, up to resistance, moves down, resistance, supports, and breaks that supports, but then continue trading down, then later breaks out of resistance, continue trading up. So this is a live example of a ranging market. So let's look at live example of a choppy market. So guys, this is a live example of a choppy market. As you can see, there is so much noise here in this chart. The best thing is to wait for this break out of this range before you can decide whether you can be a buyer or a seller. So that is it, guys. So that will be the end of this part 1 of this market structure. So if you find any value in this video, please don't fail to like this video and also click the subscription so that you'll be notified anytime I upload a new video. Thank you. I wish you all good luck and good trading.